When deciding whether to buy a property on your own or with someone else, it's essential to weigh both the financial and personal implications. Here's a detailed breakdown of the factors involved in each scenario, along with examples to help you make an informed choice. Financial strength and loan qualifications. Buying a loan means relying solely on your income, credit score, and debt-to-income ratio to qualify for a mortgage. If you have a high credit score, stable income, and manageable debt, you may qualify for favorable loan terms without needing a co-borrower. However, your borrowing power will be limited to what you can afford on your own. For example, if you earn $70,000 annually and have a credit score of 750, you might qualify for a loan of around $250,000, depending on interest rates and DTI limits. But if you have additional debt or are self-employed, lenders may view you as a higher risk, which could affect your loan amount or interest rate. On the other hand, adding a co-borrower can strengthen the application. Both incomes, credit scores, and financial assets are considered, potentially increasing your total borrowing power. However, if one person has a significantly lower credit score, it could affect the interest rate and terms. For instance, if you and a partner each earn $70,000, together you might qualify for a loan of around $500,000. This could enable you to buy a larger property or afford a better neighborhood. However, keep in mind that the lender considers both credit scores. If your partner has a 650 credit score while you have a 750, the rate may be higher than if you applied a loan. Ownership structure and legal implications. When you buy a loan, you own 100% of the property and have full control over it. This is straightforward for legal purposes, estate planning, and future resale. If you want to sell or refinance, the decision is entirely yours. For example, suppose you purchase a condo for $300,000 on your own. If the property appreciates in value, you retain 100% of the equity gained. If you choose to sell in the future, the proceeds are yours without needing anyone else's approval. Co-ownership can be set up as tenants in common or joint tenants. Joint tenants. Both owners have equal shares and rights. If one owner passes away, their share automatically transfers to the other owner. Tenants in common ownership shares can vary, and each party can leave their share to a beneficiary in their will. For example, let's say you buy a $400,000 home with a friend and contribute equally. Under a joint tenancy, you each own 50% of the property. If one of you wants to sell their share, it could complicate matters, especially if the other person isn't ready or financially able to buy out the other's interest. This could lead to conflicts or delays. Financial risks and responsibilities. When you buy a loan, you're solely responsible for the mortgage, maintenance, and taxes. This means less financial risk exposure to someone else's situation, but also full responsibility in case of financial hardship. For example, if your job situation changes, you'll need to cover all payments yourself. But if you maintain a stable income, you'll have fewer complications with other parties. Co-buying divides costs but also means you share financial risks. If one party cannot pay their share of the mortgage or other expenses, the other co-owner must cover the shortfall. Additionally, both parties' credit scores are affected by the loan, so if payments are missed, both will see a negative impact. For instance, imagine buying a property with a friend who later loses their job. You may end up covering their portion of the mortgage payments temporarily, which could strain your finances. If you both miss payments, it will impact both credit scores and put the property at risk of foreclosure. Exit strategies and future planning. Buying a loan. Exiting an investment is easier when you're the sole owner. You can refinance, rent out, or sell the property at any time without having to negotiate with a co-owner. For example, if you buy a single-family home and later decide to move, you could rent it out for passive income or sell it based on your timeline and market conditions. Buying with someone else? Exiting a shared investment can be more complex. You'd need to agree on the terms to sell or refinance. Also, if one person wants to keep the property, they may need to buy out the other's share, which can require a large sum or additional financing. For example, say you purchase a duplex with a partner, each contributing half. If one wants to exit after a few years, they may need to sell their half to the other owner or agree to sell the property together, which could lead to delays or disagreements. Personal relationship and trust. Buying a loan. There's no relationship management necessary when you buy a loan. Decisions are based on your preferences, financial goals, and timeline. Buying with someone else? When buying with a partner, whether it's a friend, family member, or significant other, trust and communication are crucial. Real estate is a long-term commitment, and disagreements can arise over maintenance, improvements, or exit strategies. If the relationship deteriorates, the property ownership could become a source of conflict. For example, if you buy a house with a friend and your relationship changes, it might affect your ability to agree on property management decisions. In extreme cases, legal action may be necessary to resolve disputes. Summary: weighing the pros and cons. Buying a loan gives you full control and responsibility and simplifies estate planning. However, you may have limited purchasing power, and you bear the financial burden alone. Buying with someone else increases buying power, divides financial responsibility, and may allow you to purchase a more desirable property. However, it requires trust, shared goals, and a legal agreement for smooth exit planning. Recommendation: consider your financial stability, relationship with the co-buyer, and long-term goals. If you're comfortable handling the full responsibility, buying a loan offers greater flexibility. However, if a co-buyer shares your vision and commitment, it could be a financially rewarding partnership.